and welcome to our OMFIF live discussion on the macroeconomic outlook in Hungary and Central and Eastern Europe. My name is Taylor Pierce, and I'm Senior Economist at OMFIF and moderator of this discussion. Here with me today are our esteemed panelists. So please allow me to introduce Andras Balatoni, Director of Economic Forecasts and Analysis at the National Bank of Hungary, Zsóka Kacán, a lead economist at the European Bank for Reconstruction and Development in the Transition Impact and Global Economics Division, Coleman Nee, Senior Economist in the Economic Research and Statistics Division of the World Trade Organization, Jakub Rybicki, Head of the Macroeconomics Team at the Polish Economic Institute, and Magdolna Sas, the Director of the Institute of World Economics at the Center for Economic and Regional Studies in Hungary. Thank you to all our panelists for joining us today. I have no doubt that we'll have an exciting and illuminating discussion on a range of issues related to the macro outlook in Central and Eastern Europe. Just to provide a few introductory remarks and guidelines, we've structured our discussion today to cover a wide range of topics, from macroeconomic factors to more specific factors in domestic economies and the pathways for convergence, and more of a forward-looking end section. Our first set of questions addresses the macroeconomic outlook for the entire region, with a focus as well on Hungary and Poland and CEE as a whole. We'll be touching on issues such as inflation, unemployment, balance of payments, external debt, and fiscal positions in the current economic global context. We'll then turn our attention to some of the trends within the region's domestic economies, where our panelists will discuss foreign direct investment, Hungary's and other economies in the region's export portfolio, supply chain relationships, and energy security. We'll then consider some of the factors influencing the path toward continuing convergence and comparative advantages among CEE economies, including how CEE countries like Hungary can diversify FDI investment inflows, promote innovation-driven enterprises, utilize EU subsidies for SMEs, diversify trade and exports, and adopt greener energy sources. So I'd very much encourage our audience to please write any questions you may have for the panel into the Slido discussion box, which you should be able to see on your screen. And I will do my best to incorporate these questions into the discussion. One final note before we get started: this virtual roundtable is part of a larger project that OMFIF is engaged in cooperation with the MNB, Hungarian Ministry of Finance, and the DMO, the AKK. So be sure to check out the other content we've put out so far on this topic, including a panel on Hungarian borrowers in global bond markets and interviews with the MNB and Ministry of Finance. We would also be delighted to welcome you to our in-person conference in Budapest on the 16th of November. So thank you all for joining us. I look forward to a productive and informative discussion, and we can begin our exploration of the economic dynamics in CEE. My first question, I'll start with you, Andras. Can you please provide an overview of the current inflation and employment situation in Hungary?
Thank you very much for the opportunity for being here. I think that is a lovely opportunity and event for us to share our views and how we think the economy is evolving looking forward. I think that is a very important phenomenon, that the disinflation was extremely sharp, not just in Hungary, but almost every CEE countries. So last year, we have seen a remarkable cost push shock that increased the inflation almost everywhere. However, I think there was also some kind of Hungarian phenomenon that the profits were also on the rising trend last year. We conducted significant amount of research, and we concluded that, okay, at the moment, the companies have some kind of buffers to decrease their prices. And if you look at the real economic activity, you can conclude that actually the demand is already a very important disciplinary power of the pricing dynamics. So in the second quarter, the Hungarian GDP declined by 2.3%. But if you take into consideration that the agriculture contributed to the growth positively by 1.7%, only as a consequence of the last year's very poor basis, then you can conclude that actually the underlying dynamics of the real economy is much worse, roughly 4% year-on-year drop. And that kind of drop is stemming from the domestic absorption. That means that the very high inflation ate up the purchasing power of the households, and also the gross fixed capital formation is in the declining trend. So that was a very important factor that curb the inflation dynamics. And that was also stemming from external factors. That means that oil prices, gas prices, and the raw material prices were also in a declining trend. So that is the reason why the headline CPI has halved. So it was above 25% in January. That was the top, and now it is 12.2%. And looking forward, we expect further decline of the headline CPI up to the end of this year. And by the end of this year, I mean in December, we are going to see an inflation rate between 7 and 8%. However, that is a very important message from the National Bank of Hungary that 7-8%, so one-digit inflation, is unacceptable for the National Bank. So we have an inflation target that is 3%. And we must reach further disinflation in the economy. Next year, that will be a bit more challenging because a lot of tax changes is coming into the game, and those are going to slow down the disinflationary process next year. That's why we think that the headline inflation, will be between 4 and 6% next year, and we are going to reach our tolerance band in 2025. And in 2025, we are going to reach the 3% inflation target again. Looking from the real economic side of the story, as I have mentioned earlier, the very high inflation, had a negative effect on growth, had a negative effect on domestic absorption. But that is a very positive phenomenon that still the labor market is very strong. So despite the fact that actually the economy is shrinking has been shrinking in the last 4 quarters, the employment is actually increasing, and also the number of vacancies are increasing. Only one sector reports the decline in employment, that is the construction sector, mainly as a consequence of the drop of the gross fixed capital formation of the government, which consists of road and railroad construction and reconstruction projects. And that is a significant part of the output of the construction sector. But altogether, the labor market is a very strong basis of very strong fundamental of the Hungarian economy. And looking forward, we think that as the disinflation is going to go on, the purchasing power of the household is going to increase by the end of this year. I mean, in these months already, we think the real wages are already increasing, and the domestic demand is going to come back. And since the companies have the sufficient amount of labor, they can adjust to that kind of demand very fast because they have the capacities to produce more goods and services looking forward. So that's why we think that the economy can bounce back, and the economic growth is going to be between 3 and 4% next year, and also we expect between 3 and 4% GDP growth for 2025. Sorry, that is the end of our forecast horizon. So, in a nutshell, that is my wrap up of the Hungarian economic dynamics.
Thank you, András, and I'll come to you, Jakub, in a second to get the Polish story. But just as a follow-up, you mentioned obviously inflation's coming down, the labor market looks healthy, but how is the MNB making sure that inflation expectations are managed in Hungary, and how do you assess the effectiveness of those policies so far?
That is a very important question, and we are aware that the longer term, the anchor of the longer term price dynamics are the expectation. But if there are some surveys, those try to grab the inflation expectation of the businesses, and they try to grab the inflation expectation of the households. What I can see at the moment, that the inflation expectation of the businesses sunk significantly compared to the end of last year, and closer to 2019-2018 levels. So there was a massive drop in the case of inflation expectation of businesses, both retail, industrial inflation expectation, industrial companies inflation expectation, price expectation, and also construction sector. So that's and those are rather the leading indicators of inflation, because usually the inflation expectation of the households are backward-looking, freed money and style adaptive kind of expectation, usually what we see in the case of household sector. So we have to convince the household sector that this inflation is going to happen and it is on demand. And already the short-term inflation figures are very favorable. So if you look at the 3 months changes in the 3 months changes in the core inflation basket, those are actually almost below the EU average. So that kind of Hungarian additional inflation has vanished from the system already. And as the households are going to experience those kind of disinflationary process, we firmly believe that we are going to manage those kind of expectations with lower price dynamics. But again, I have to emphasize that the price expectation of the businesses are already in line with our 3% inflation target, and the short basis inflation figures are already significantly lower than a couple of quarters ago, and actually below the EU average. So short-term underlying figures are already extremely favorable, and we think that that's what counts at the moment. And let me add only one thing. Sorry, I'm speaking too much at the moment, but we were the first central banks in Europe who increased the base rate and tightened the monetary conditions back then in June 2021, and we increased to the highest level. We increased the base rate and the short-term interest rate to the highest level. So I think our commitment is visible. May I just suggest that? So we know that inflation is our primary objective, and really we do our best to anchor those inflation. And our whole stance, I think, suggests that yes, we are dealing with inflation, and we are not happy with one-digit inflation. We must reach the 3% inflation target in our monetary horizon.
Thank you, Andras, for outlining that. I'll now come to you, Jakub. Could you give us an overview of the macroeconomic indicators in the Polish economy, and maybe if you could also provide some insight on how you're perceiving the economic implications of the recent election in Poland? Obviously, they haven't formed a government yet, but yeah, your thoughts on how that could play out as well.
Okay, starting from the inflation, we have very good progress. Like inflation since February dropped down from 18.4% to 6.5%. But right now we are rather entering a phase of slow decrease of inflation. The expectation is that inflation might actually pick up slightly until December. At the end of the year, amount something around 7%. And drop modestly in 2024. Of course, this the expectation, like consensus is right now at 5.6% on average for the whole 2024. So the end year inflation will be rather below 5%, but still slightly above the inflation target. But much of this is dependent on, first of all, the behavior of administered price. Right now we have freeze on energy prices and zero VAT rate on the food prices. The zero VAT rate probably would be abandoned in the January. This would add around 0.8 to the CPI. The energy freeze probably will be maintained in the first half of the year, but in the second one, this will be probably scraped or partially scraped, and this will be another impulse for the inflation. All in all, the situation is like the trend is still towards decreasing the inflation, but the pace should be less impressive than here in 2023, and probably the risks are still to the upside, especially given the fact that the inflation expectations are still not in line with the inflation target. Right now, the surveys indicates that the prices that the share of the enterprises who are deciding to increase prices is consistent with a level of around 4%. So still this is above the inflation target. If you look at share of prices which expand at 2% or lower, this is still 15%. In normal times, it should be around 50. So here there's still a long way to the to reach actually the inflation target. What are the policy implications? Right now, the NBP start cutting, the National Bank of Poland start cutting rates. In the last month, we have the 25 basis point cut. A month ago in September, 75 basis points. This cuts will be probably short-lived. Like the expectations are now for another 25 basis point in November on Wednesday, but then probably a pause till March or till even the July. Here much dependent on here the MPC will be data dependent. They will be waiting on the first of all rise of inflation, Secondly, the weak performance of the GDP. Right now, the economic growth is returning towards positive level, at least on year-on-year figures, but still we are much below comparing to our potential output. The GDP is expected to increase around 0 this year and around 2% next year, but usually the Polish economy expanded by 3% per annum, so we are still a long way to reach the potential output to actually to close the output gap. Nevertheless, if here we are going to the elections, what we can expect is that the policy will be the fiscal policy would be expansive. So this is, of course, the argument for maintaining rates at higher level, rather for the modest easing in line with the inflation drop. So far, the NBP, let's say, the cut rates, despite the ex-ante real interest rate was below 0. This is something which is opposite to, let's say, the Central Bank of Czech or even Hungary. Let's say the prospect of accommodative fiscal policy and high deficit, one probably of the highest in the European Union. Right now, the budget will assume 4.5% GDP deficit in 2024. Like with the new government, new election pledges, it might be even higher. So here, like the backdrop is rather supporting the modest easing from the monetary policy in line with the falling inflation, with the rather positive real interest rate, even on ex-ante basis.
Thank you, Jakub. This has given us a really good overview of the situation in Hungary and Poland, and I wonder now if Joka, if you can provide some insight on any regional overviews or specific country cases that might be more outliers, or is the inflation and employment story similar across the CEE region?
Sure. First of all, thank you very much for having me. It's really a pleasure, and I look forward to the discussion. Perhaps to add a couple more points on disinflation, both its speed and its nature, to what András and Jakub have said before me. So we were looking at historical disinflation episodes in emerging Europe, for instance, in 2000, 2008. And what we see as general patterns is relatively quicker disinflation in the first few months after the peak, and then disinflation slowing over time, which is consistent with what we've seen in the last few monthly readings so far. This is true for most economies in Central, Eastern, and Southeastern Europe. What we, of course, also see, and this is consistent with the slowing nature of disinflation, is that initially food and energy accounted for the bulk of inflation. The share of these has by now come down so that it's actually mostly core inflation by now. We see similar patterns. So goods inflation has come down, whereas services price inflation has been slower to decrease from its peak. Again, true for most economies, including Hungary, but more generally, Central Europe. One thing that is important to note here, and perhaps has received less policy attention, is that food imports have tended to play a stabilizing role in the food market. So the prices of imported food products actually increased less relative to domestically produced food staples. As a very quick aside, in case this is relevant for any of your consumption baskets, the prices of food actually behave a lot like goods prices. So with relatively short-lived peaks and quick disinflation, prices of drinks, coffee, tea, beer, and wine look much more like service price inflation. So have actually been more sluggish to come down. Perhaps adding a few words on employment as well. I think indeed we have been seeing tight labor markets across a number of economies in emerging Europe. Perhaps two things to highlight here is, on the one hand, that the low unemployment rates also, of course, incorporate heavy out-migration. And this is not new. This has been going on and is characteristic of many economies in this region. But perhaps in terms of a shorter term effect, I would talk a little bit about the energy prices, because we did some analysis that looked at how Europe adjusted to higher energy prices over the 22-23 winter. And we've seen that there has been about a 20% decrease in gas consumption as a reaction to this. And most of this was actually due to shifts in terms of industrial production away from more gas-intensive industries that include construction. And as András said, and as we've been hearing lately, this is a sector which is slowing in many of these economies. But other gas-intensive industries would, for instance, include chemicals, base metals, and output has been shifting instead to industries that are less gas-intensive, for instance, pharmaceuticals. We've seen this in Germany to a very large extent. We also see it across emerging Europe. However, so far, there have not been major layoffs in the industries where output has shifted away from. This suggests that going forward, we may be seeing some layoffs in these industries, or in turn that there may be some fiscal cost to maintaining employment in these industries, even in the context of lower output. But for now, we're definitely seeing a pattern with relatively strong wage growth and tight labor markets together with slower, even negative GDP numbers.
Thank you, Shoka. And maybe if you could just as a follow-up, since you mentioned energy price fluctuations and potential vulnerabilities, do you see, in the context of ongoing geopolitical tensions, the risks to the upside there, and what would the implications be for industry there?
The effects of ongoing geopolitical tensions on energy are, of course, very difficult to predict. Countries that are significant energy importers are vulnerable. We've seen, for instance, significant deterioration in current accounts for many economies that rely on food, on energy imports. In this context, what may be important to highlight is that we have seen a lot of the adjustment of the last winter already in terms of industrial production that I mentioned. In some economies, there have been shifts towards renewables. In North Macedonia and Greece, for instance, and often in the same economies, there has also been a shift towards fossil fuels, in particular coal. In Hungary, we've seen a shift towards nuclear. So some of the adjustment to higher energy prices has already taken place. But of course, it also means that any further adjustment at the margin becomes more difficult, as the easiest adjustments have been made already. So this makes energy importers, of course, vulnerable to further potential price increases.
Thank you. I'd like to shift now on the topic of energy to Coleman, since you've been patiently waiting. In the context of what we've been discussing, obviously the risks that energy price shocks could how this could challenge the region, and especially industry in CEE. Can you talk a bit about the key considerations and challenges related to energy security and the energy mix, specifically in Hungary or more broadly in CEE?
Sure. Well, Hungary relies heavily on imported energy, has little domestic oil and natural gas, and modest reserves of coal. Hungary's traditionally imported a lot of energy from Russia, but the recent conflict has reduced that sharply. If, for instance, imports of natural gas from Russia in the first half of 2023 are down 47% compared to 2021, before the outbreak of the war in Ukraine. But meanwhile, trade has allowed Hungary to, it's been diversifying its sources of energy. So its imports of natural gas from Poland and Netherlands were both up 84%. And Romania was up an undefined amount because it was zero in 2021. So anyway, it's already been mentioned that Hungary has been relying more on coal generation, but natural gas currently accounts for about 40% of Hungary's fuel imports, and around 24% is electricity, and electricity in trade data is counted as fuels, and oil around 30%. So while natural gas and petroleum products are expected to remain the main sources of energy for Hungary in the coming years, nuclear power has been increasing the role of that, with the addition of two new reactors at the main nuclear plant in Hungary. And so that should only rise. Also, in going forward, with the green transition to green energy sources, the share of renewables is going to be more and more important. The share of solar and wind is quite small in Hungary, but it's been rising. It's risen fourfold since 1990. And the same with biomass energy. So Hungary's been trying to diversify its energy supplies, and like a lot of European countries, though, the high cost of energy in the past year has slowed economic growth, and in fact trade growth as well. So in 2023, in the first half of the year, Hungary's exports are up 2.4%. In merchandise exports are up 2.4% in volume terms compared to the previous year. But that's better than the EU average, which, according to our most recent trade forecast released on the 5th of October, we project European growth broadly to rise only just exports to rise 0.4%. On the import side, Hungary's import growth has also slowed to 1.5% in 2023, but that again is stronger than Europe-wide growth, which is expected to contract by 0.7%. So I think that would be I think that's all I have on energy immediately, but
Sure.
I could also talk about the supply chain relationships.
Yes, that's what I was going to come to
Yeah.
now. So if you could talk about exactly supply chain relationships, Hungary and the export portfolio, and how these relationships might be evolving, and especially with a view toward diversification in the face of a difficult geopolitical environment.
Sure. Well, Hungary's an open economy and with a strong manufacturing base that's focused on automotive products exports, also electronics and other machinery. But like a lot of countries in the last few years, trade patterns have been disrupted by first the pandemic, then the war in Ukraine, and now there's increasing concerns about geopolitical tensions influencing trade flows, perhaps leading to nearshoring and friendshoring. However, there's also, if we look in the data, we find a surprising amount of stability in Hungary's supply chain relationships. So, for example, the share of manufacturers in Hungary's exports and imports, merchandise exports and imports, fell from 85% on the export side to 82% in 2022, and then rose back to 86% in the first half of 2023. Over the same period, imports, the share of manufacturers also fell from 79.5% in 2018 to 73% in 2022, and then back up to 78%. So some of this this may be the shifts in 2023. There's some concern that it's related to rising geopolitical tensions, but it could also be just a reversion to pre-pandemic trade patterns. So the part of that would be due to rising oil prices, but if we just look at the share of, let's say, intermediate goods, actually parts and components, a lot of it for Hungary is automotive products. In Hungary's merchandise imports, it fell from 32% in 2018 to 30% in 2022, and then rose back to 32% in the first half of 2023. But looking at the trade by partners, the share of intermediate goods, which is a kind of a proxy for supply chain, the extent of supply chains, Hungary's the share of the EU countries and Hungary's imports of parts and components fell from 72% in 2018 to 66% in 2022, the share in manufacturers' exports. But then in 2023, it's risen back to 71%. Over the same period, the share of Asian economies in Hungary's imports of parts and components rose from 20% to 27%, but now it's fallen back to 22%. So this suggests that there was a big disruption due to the pandemic initially, and then perhaps with the rhetorical excuse of geopolitical tensions, but it looks like some of these trends are just reverting to the pre-pandemic patterns. As for Hungary's trade with other Central and Eastern European countries, their share in Hungary's parts and components imports has been relatively steady, only fluctuating between 14 and 16%. Between 2018 and 2023. So in a sense, its relationship with its closest neighbors provides a kind of a cushion to global macroeconomic shocks that have been coming so quickly in recent years. So in a sense, Hungary's displaying the same kind of thing that we see at the global level. We've noticed that there has, in our recent research reports, that there's some evidence of perhaps countries of fragmentation in international trade, but it's just possible and preliminary. We don't see a broader sense of deglobalization or cutting off trade with traditional trading partners. So, for example, the WTO's most recent World Trade Report, which is our flagship publication, noted that there's an increasing share at the global level of trade between like-minded countries. So this could be a sign of friendshoring, like-minded defined as similarity in their UN voting patterns. And but this has just been a small change and not dramatic. Similarly, the share of intermediate goods, non-fuel intermediate goods in world trade has declined to around 48% in the first half of 2023 from 51% over the previous 3 years. Now, this could be a sign of retrenchment of supply chains, but I think it's certainly not a dramatic shift. And supply chains are always shifting. They're evolving in relation to changing technologies. And this is an area that Hungary is going to find challenging, including and also its trading partners in Europe and particularly Germany, with the move towards greener energy sources and electric vehicles. Countries with important automotive sectors will have to evolve with changing trends and face competition from new suppliers. For instance, in 2023, in the first half of the year, China's exports of vehicles doubled, and it may end up being, it's been said that it might be the world's leading exporter of vehicles in 2023. I'm not sure if that's the case. but depends on which segment of automotive products you look at. But in any case, there's going to be a need for Hungary to its exports to for investment in these sectors to keep up with new technologies. This could be an opportunity as well, not just a threatening development.
Great, thank you, Coleman. And that is a perfect segue for me to come to Magdalena. But first, I just wanted to see if Jakub or Joka wanted to comment either from the Polish perspective on the trade patterns that Coleman laid out for Hungary, if those apply to Poland, or Joka, if you wanted to comment more broadly across the region, if we're seeing more of a retrenchment of traditional supply chain relationships or diversification there. Jakub?
In case of Poland, what we might see is actually the higher number of inward foreign direct investment. It's also probably visible in the region. In case of Poland, last year's FDI inflow was close to 5% of GDP. Usually it's around 3%. So here the number is definitely bigger. The outlook, the forecasts are also higher comparing to the historical levels. Like right now for 2024 is something around 3.8%. This is the consensus economic estimates. We see that the European companies tend to retain earnings, tend to invest in another assembly line in Poland, especially in the automotive sector and in the manufacturing EV batteries. We see some investments in the heat pumps industries. We see some flows related to energy, related to the automotive sector. This makes, let's say, our industry more high-tech, more competitive. If we look at the trading partners, I think there's no bigger changes. Like prior to the pandemic, the majority of export from Poland was oriented towards the European Union. The share has not changed strongly. The big we have big import from China. There is still in place, and the prospects are rather that it will sustain in the forthcoming years. So we may see still the dynamic increase of the production here domestically in Poland in the region, but overall, if we look at the structures of trade partners, I do not expect the big changes.
Yeah, Joka, any comment here? Thank you.
Maybe just to add and reiterate really that these many economies in Central Europe, Hungary included, are highly open, highly integrated economies into supply chains, which means that exports of Hungary, but also the Slovak Republic, Slovenia, co-move very much with what happens in advanced Europe, especially with Germany. Export correlations with Germany's exports reach 70–80%. So these countries have, of course, benefited tremendously from foreign direct investment inflows over the last 15–20 years and from being included in these supply chains. But it's also a mechanism through which shocks can be propagated and a mechanism through which they will feel the slowdown that is happening in advanced Europe, and especially the very difficult time that Germany is facing at the moment.
Thank you, Joka. That's a perfect segue for you, Magdalena. Finally, I'm sorry, you've been waiting quite patiently, but please, can you give us an overview of the FDI story in Hungary and the region right now? Maybe also touching on a retrenchment or diversification of FDI flows. Thank you.
Yeah. Thank you very much for inviting me. I think that's a very important question now, the FDI question, because it has a high share in all economies of the region, in the Visegrad countries, between 50–60% of GDP. Of course, in Poland it's lower because it's a bigger country, and also it is lower in Czechia. So basically we can talk about Slovakia and Hungary, who are very similar to each other, because Czechia, in the case of Czechia, we have a very high share of round-tripping FDI, which is in reality Czech FDI, but it is recorded as foreign. So I would say that Slovakia and Hungary are the champions in terms of their exposure to FDI and reliance on FDI in the region. What we could see at after the pandemic, immediately we had a look at the most important projects, and we saw that in terms of the number of projects, we can see a kind of move towards higher value-added projects like IT, research and development centers, and so on, business services. In all the countries of the region. But most recently, we can find a kind of deviation from that in the case of Hungary in terms of not on the number of projects, but rather in terms of the FDI inflows and the capital coming with FDI into the country, because we can see that Hungary is very much targeting Asian investors, especially in the electronic battery segment in various parts and components production, as well as assembly of electronic batteries. This has actually resulted in an increase in the share of Asian foreign direct investments in total in FDI, and in that respect now Hungary deviates a little bit from the other countries of the region. So overall Asian FDI is representing now 24%, and this should be seen in the light of the fact that the share of Germany has decreased to 17% in 2021. Always Germany is the leading investor in Hungary, but its share has somehow decreased in the last years. Interestingly enough, the share of European investments has even increased a little bit more. So we can see here basically a kind of losing ground for Germany in terms of Hungary. So now Germany is still the #1 investor in Hungary, followed by Austria and the US, but then come quite many Asian countries, especially South Korea, China, and Japan. Here, what is also I think important to note is that these very large projects, basically these are very large projects coming from Asia, are very important from the point of view that they may have much less, even less than the previous ones, spillovers, positive spillovers on the economy, because they rely, compared to European investors, even less on local supplies, and they sell much less locally. They are very export platform type of foreign direct investments, selling mainly to Europe or to Hungarian based automotive companies and subsidiaries. Also, what I wanted to and just to underline what was already mentioned by Coleman and Joka, that this kind of very high reliance on FDI in the Visegrad countries can be seen also as a high reliance on global value chain participation. So this is not almost all FDI which is now in these countries is very much connected to global value chain related activities, and this is making the countries the economies vulnerable. On top of that, this most recent move towards this e-battery type of investments is increasing the level of specialization, the level of concentration in terms of activities in FDI more in Hungary, to the level of Slovakia, which was also very much exposed to automotive FDI in the past years. In Hungary, we can see a very similar move towards e-battery and e-vehicle FDI reliance, which in itself is making a little bit vulnerable the country.
Sorry, yeah, we were finished. Okay, I apologize. I wanted to just follow up with this question you mentioned, so that the concentration of FDI is leading to some vulnerabilities. Andras, I wonder if you could comment on the MNB's approach or stance on FDI, and if there's any active initiatives to help diversify not only the sources of FDI, but also the industries where FDI is flowing to.
I think the effect of the FDI depends really heavily on the actual state of the economy. So back then in 2012, 2011, when the unemployment rate was extremely high in Hungary, I think every productive capacity was more than welcomed here in the country, because it had significant spillover, not just through the value chains, but also from the macroeconomic point of view. It generated export revenue, and it generated purchasing power for the households and the genius kind of growth trajectory. At the moment, I think we have to acknowledge, what we have reached, and that is full employment. And if you have full employment and you support the FDI to increase the number of employees working for foreign investment founded firms, you have to grab those employees from locally owned firms. So that's why it is really challenging at the moment how to attract the proper FDI to Hungary, because yes, if you have a significant amount of spillover effect or domestic added value, then I think that kind of FDI is still very positive for the development for the Hungarian economy. But if you look at the aggregate figures, then you can conclude that actually we have almost, I think, the second lowest or third lowest added value content of export within the EU countries. So that means that we export a lot, but we import a lot, and the local knowledge, the local how does it call, factors of productions are not built into those projects or into those products we are exporting towards Western European countries. So that's why we think that we are maybe not in the best part of the global value chain, because we are concentrating rather on production, and we should rather go to the research and development and innovation side of the production chain, because that part of the production chain contains much more significant amount of added value. But at the moment, again, I just can repeat myself, with that kind of FDI inward strategy, we reached extremely low added value content of export. So we can be proud of our export numbers, but to translate it to GDP, the picture is not that rosy. And that's why we think that we have to concentrate rather on quality and not quantity anymore. And we should attract FDI that is good for the local SMEs, for the Hungarian-owned enterprises, and that has a significant positive spillover effect, both from the supply and from the demand side as well.
Thank you, Andras. I want to just remind the audience that if you have any questions, please do post them in the Slido box, and I will try to incorporate them into the discussion. Magdalena, I wanted to come back to you and see if you had a follow-up to that, and if you could speak on the dominance of multinational enterprises versus the growth of Hungarian SMEs in the economy.
Yes, that's what I see exactly, that these Asian kind of investors have even less inclination to bring in high value added activities to Hungary, and that makes actually this kind of strategy, as Andras mentioned, quite problematic from the point of view of the further development of the Hungarian economy. So this special Hungarian strategy may not pay back at the end, and that's I think very important. On the other hand, as I mentioned, these Asian investors are even less inclined compared to, for example, the European ones to rely on domestic supplies. So domestic firms, even if they approach them, and I know about company cases, they cannot get any kind of supplier contracts from these investors, which means that their kind of local impact can be very, very limited. And on the other hand, as it was already mentioned, the problem is that these will be operated mainly by imported workers coming from Asia. So that can also pose a question about their sustainability. I think it is important to note that that in the main sectors, in the main industries, we have a very high reliance on foreign direct investments, and also it is very much connected to global value chains. So as it was mentioned, the automotive and electronics industries have, in terms of added value, in terms of production, more than 90% share of foreign investors, which is also something which is problematic from the point of view of the integration and the contribution of these sectors to the Hungarian economy. On the other hand, we have to also mention that the low level of local supplies depends, of course, on one hand on the multinationals who are not looking for very much for domestic supplies, but also on the domestic economy structure in which we have a big problem with the missing medium-sized enterprises. So we have very few medium-sized enterprises. Multinationals usually have their demands in terms of not only quality, but also quantity. And many Hungarian companies are simply not able to produce the required quantity for these foreign-owned companies. So this is also one problem with the domestic supplies and limited spillovers which are coming from these foreign-owned firms. The Hungarian government tried to address this problem with many rounds of supplier programs, but they were not very helpful. So we can see that there are very few Hungarian suppliers who could really benefit from supplying foreign-owned companies from being integrated into these supply chains or global value chains, which are very much present and dominating in the automotive and electronics sectors. On the other hand, there are a few Hungarian larger sized companies who benefited, but their number is not very high. But still, we can see the rise of certain Hungarian companies who could really become and benefit from being integrated into these global value chains. For example, a plastic company, Jász Plastic, who is also a foreign investor, a Hungarian multinational. Videoton is another company which could benefit from that. Hajdú is another important supplier. So there are some success stories, but still overall, we can say that the level of domestic supplies in these foreign-owned subsidiaries remained quite low, remained much below the expectations in Hungary. Thank you.
Thank you, Magdalena. Maybe Andras, I would come to you, and if you could either respond to Magdalena or if you could discuss Hungary's progress in fostering some innovation-driven enterprises and their impact on the real economy, just to shift the conversation now to the more forward-looking point on continuing convergence in CEE.
All right, so thank you very much. As you know, we had a joint research with the MIT. We are participating at the MIT Regional Economic Accelerating Program. That is a 2-year program. And in that program, we are investigating the innovation-driven enterprises. Those have something to do with innovation. I mean, they had a trademark, or they get some tax reliance because they are doing research and development. And we build up a whole database about those enterprises. And we peak from the innovative enterprises. They had some kind of non-linear or exponential growth in the case of sales. That means that those companies are both innovative and gazelles in the dimension of the OECD. That means that they could increase their revenues 20% for 3 consecutive years. And we allocated 1,100 companies, or we found 1,100 companies. That is 0.3% of the total population of the Hungarian companies, but they produce 13% of the exports and almost 25% of the GDP growth between 2010 and 2019. So that means that a very small segment of the Hungarian entrepreneurs or enterprises produce a significant amount of GDP growth and a significant amount of imports. And those are rather domestic owned, smaller scale companies. And I think that we have to know these companies, and we have to have a conversation with them, and we are going to organize local events with them, and really looking forward to have further information about those. Those are named HYDEs. That means Hungarian innovation-driven companies. And why Hyde, Dr. Jekyll and Mr. Hyde? Because those are the hidden champions of the Hungarian ecosystem, and actually no one knew about them, because that was the first comprehensive research about those companies. And we wrote actually a paper about it. That is the growth report, which was published in June this year. And we are going to organize several larger conferences about these companies, which is really interesting for us. And hopefully we are going to see each other on those conferences as well. So those are the heights. I think we have to concentrate rather our own strengths and we have to locate our domestic champions, and we have to locate our domestic resources in order to build our strategy on those strengths and those resources and those companies. I think that is very important. That looking forward, we cannot import the capital and the technology anymore, because we have reached a certain level of development where you have to concentrate rather on your intensive kind of knowledge-based factors of growth, or innovation-driven factors of growth. And I think that shift is very important, not just for the community to speak about much more on innovation-driven growth, but also for the economic policy to turn towards innovation-driven growth trajectories, which is the way looking forward, according to our analysis.
Thank you, Andras. I wonder if, Jakub, if you could comment on this phenomenon in Poland as well, and if you could comment specifically on what policy initiatives are any that you know of, or how the Polish economy could try to overcome this issue of internationalization to foster that intensive, innovative growth that Andras outlined.
Okay, if we look at the, let's say, European Innovation Scoreboard, the Poland we'll see the Poland has some successes, but also some problems. Like if we have quite a big increase of the high-tech industries comparing to those years, we are still lagging in case of the acknowledged intent services, and in case of innovative engagements in the small and medium enterprises. If you look what R&D researchers are placed in Poland, it is mainly the big companies like the Samsung, like other electronics producers. Here we have, let's say, test centers. Like they are doing some R&D. If we look at the aggregate basis, the share of the expenditure comparing to the GDP is probably not that impressive, but like it still is increasing. But the gap is on the small companies, on the service companies. And here there work on the government. We have new tax incentives called IP box. It allowed to lower the VAT, the CAT rate on the innovative expenditures on the R&D. Let's say the frequency of using this, the outcome is probably not that big. We still have a problem to create the in-house software house for, let's say, developing artificial intelligence, developing the drone industry. Like we see still difficulties in engaging in such activities. And to be honest, I do not think that this will be easily tackled right now. This is not probably the biggest problem on the government agenda, on the policy. In case of policy, like probably this is the same issue which is faced in the region. Like what we may be able to benefit at the EU level is probably to coordinate more the R&D expenditures within the union. This may somehow help, but on the domestic policies, I don't expect any big successes right now. Like we try to incentivize the companies with taxes, but I think the taxes is not everything. Like we're still missing the problem with business risk. We're still missing a problem with lack of the capital, and here we probably the fostering the access to the market on the EU-wide level probably would be beneficial more comparing to the domestic efforts.
Understood. Thank you. Joka, did you have any comments that you wanted to add on this sort of issue of promoting that intensive growth across the region and among national economies throughout the CEE region? Because I don't think it's just Hungary and Poland that are looking to capitalize there.
Indeed, it is a much broader concern facing many of these economies. Many of them are looking for exporters for spillovers from foreign direct investment, for means of gaining know-how. Perhaps on the foreign direct investment points, because there has been a lot of discussion on this earlier, maybe just to add two things. One of them is that on the one hand, we see that economies that have been relatively late joiners to the foreign direct investment boom in emerging Europe have perhaps been a bit more conscious early on in terms of the sectors and skills that they were attracting foreign direct investment into. For instance, the Western Balkans arrived relatively late, but perhaps with more of a strategy upfront on the type of FDI that they were attracting. We heard a lot about the increasing role of FDI from Asia and from China in particular. And here we were looking at a very detailed database, the Financial Times FDI database that is project level. And we were looking at FDI investments across the countries where EBRD operates, so covering emerging Europe, but also Caucasus, Central Asia, and parts of North Africa. And one of the patterns that stood out to us was that foreign direct investments by Chinese investments, indeed, as Magdalena said, tended to be larger. They tended to be more capital intensive. And in general, nonetheless, even though the role of China has been increasing, the sort of export correlations and growth correlations that I mentioned earlier between Central Europe and Germany are still much lower, even for Central Asian economies, where China is, of course, a much more important trading partner, with the notable exception of Mongolia. But perhaps to end on the last point on FDI and being more conscious about the sort of sectors that this is attracted to, also perhaps being more conscious about its locations, because many of the early FDI inflows went, though into secondary cities, into cities that were typically doing already well, that were growing, or that had, for instance, a car manufacturing past. As FDI starts shifting into services, as Magdalena said, into R&D, into higher value-added, more tech centers, it is again becoming concentrated in larger cities. So perhaps conscious efforts to pay attention to how much of this is exacerbating differences between capital cities and the rest of the country.
Thank you, Shoka. I think that's a great way to segue into this topic of regionalization and spatial inequality. I was wondering if you wanted to comment any more there on what strategies are being taken to address this, either by what the EBRD is encouraging at the national level, and maybe with a view toward the labor market and productivity in some of these secondary regions and cities.
Of course, it's a topic that is close to my heart, and I think especially because I don't think it is receiving as much attention in emerging Europe as it is in some advanced economies. We hear a lot of discussions of flyover country in the Rust Belt in the US, declining industrial towns in the UK. And we mentioned the effects of demography and its impact on labor markets. Many of emerging European economies are, in some sense, growing old before they're growing rich. So they're facing many of the issues that advanced economies are facing, but still at lower levels of development. So on the one hand, we see low fertility rates, but unlike in many advanced economies, we see very significant outmigration, see very little immigration flows that could be providing much needed workers and skills. And in general, and this is of course also related to broader forces of technological change and globalization, most economies we see concentration towards capital cities. Now, in the former transition economies, the historical legacy is a little different because they tended to be relatively highly urbanized compared to their level of development, with relatively more dispersed settlement patterns, so larger role of secondary cities when they enter transition. But the transition years of the 90s, with all the changes in terms of shifts in industrial production that accompanied them, were not kind to many of these secondary cities. Magdalena was talking earlier about the missing middle in terms of firms. I think this is very much echoed in a geographic sense as well, that there are a few secondary cities that we can see as success stories, that managed to indeed attract the FDI into services, into higher value added sectors, that managed to diversify their labor markets. But on the other hand, we see just booming capital cities, and that many secondary cities, and especially smaller towns, and in particular those relying on a single dominant employer, have really struggled. And with this came widening inequalities in the 90s, in some sense also exacerbated, especially by some of the early FDI inflows. Now, in terms of policies, the state played an important role in terms of mitigating these disparities, because the public sector, whether healthcare, education, administration more generally, but also state-owned enterprises, often account for a larger share of employment in relatively lagging regions, because even, for instance, small villages would have a school or a post office or some employment in a municipal utility company or a railway. But the private sector is often facing fundamental coordination issues. And as the state withdrew, we see widening disparities. And I think this is where much more conscious policies would be needed, whether in directing and coordinating private sector investment, whether domestic or foreign, because otherwise we really see a divergence where the capital cities are booming. Budapest, Bratislava, Warsaw are very much converging to Berlin and London, but the rest of the countries are falling behind.
Thank you, Choka. You've outlined a lot of really important issues there, and I maybe just want to open it up to the panel if anyone wanted to comment on that. Magdalena, maybe?
Just one very short comment, just to reinforce what was said by Zsóka, that even new FDI, which is coming either into IT business services or R&D, is located in already kind of picked up locations. And the same is the case with e-batteries. We compiled a map of e-battery investments, and it seems that they are targeting the same regions which already are host to significant foreign direct investment. So it seems that these two new types of investments will exacerbate the already problematic regional inequalities in Hungary. Thank you.
Thank you. It looks like we still don't have any audience questions, so I guess if that's the case, I will probably start to maybe bring our discussion to the end, and we can move towards some more concluding remarks, and we might wrap up just a few minutes early if that's okay with everyone. Coleman, you've been patiently waiting. Maybe I'll come to you now and just shift the focus a bit. Forward-looking points, concluding remarks, can you elaborate on any efforts to diversify trade and exports, and maybe also move toward green energy sources in CEE and Hungary in the very challenging macroeconomic environment?
Well, one thing is, I think, that contributes to foreign investment and economic growth globally and also in the Central and Eastern European countries is having a predictable and transparent global trading system. Now, trade has come under a lot of rhetorical attack in recent years. My early remarks, I pointed out that there has been a remarkable stability in supplier relationships and so forth, but still there's been a lack of dynamism in international trade growth, and some of this is because of a lack of progress on trade liberalization. If you look back to the 1990s and early 2000s, you had trade growing roughly twice as fast as world GDP, at least measured at market exchange rates. And since the financial crisis of 2008, 2009, trade has grown roughly 1-to-1 in terms of relative to global GDP growth. And in that earlier period, we had liberalizations in terms of the completion of the EU single market, the country's former planned economies of Eastern Europe joining the EU. You had the creation of NAFTA. You had the creation of the WTO itself, and all of these contributed to a period of much stronger global economic growth. And it's been much more sluggish since then. And although the countries in Central and Eastern Europe are represented in the WTO through the EU, it still has a lot of impact on your economies. There have been there are discussions ongoing in the WTO on environmental goods, on e-commerce. There have been the two information technology plurilateral agreements that have underpinned the digital economy. And all of these create opportunities and challenges for your countries. So I think it's important that we try to depoliticize some of the charged rhetoric about trade. Trade does create challenges for equality, for instance, regional disparities, but at the same time, it creates greater opportunities in terms of growth and investment. And so that's the one thing I would suggest is just trying through the EU to try to invigorate the international trading system, and especially it's important as we come up to the ministerial conference next year in Abu Dhabi.
Thank you, Coleman. Magdalena, I wonder if you want to follow up with your concluding remarks and what CE countries should be thinking about to address some of the issues that you laid out around FDI and internationalization versus promoting domestic enterprise.
Yes, I think that's important what András mentioned, that we have to look for the innovative companies, innovative cases, the success cases, and to try to learn from what are the main factors. But in that respect, I see with some kind of dismal what is going on in Hungary, that there is an increased state intervention in the economy, which is making all these successes very kind of, in some cases controversial, in other cases relative. And I think that's a major problem, not only in Hungary, but I can see that in everywhere in the world there is an increased kind of state intervention, first after the 2008 and 2009 crisis, now after the COVID pandemic, which is actually somehow reducing the role of the market, which is from an innovation point of view is not a good thing, I think. So that's what I see one of the major dangers in the coming years. How can we actually get back to a higher, to a more market-based economy where real successes are created, where performance of firms is based on their actual attainment and performance, and not on various kind of state interventions and subsidies. So that would be my very, very general remark at the end. Thank you.
Thank you, Magdalena. I guess outcome, yes, András, please go ahead.
We really firmly believe that competition triggers competitiveness. And that's why we have published one of the largest database, I think last week, joint with the Hungarian Competition Authority, that incorporates 80 figures, 80 indices for all the branches in Hungary from 2003 up to 2021. That tries to grab the market structure of different branches, the profitability of those branches. And I suggest for everyone who would like to deal with those issues, that is available online freely for everyone on the website of both the National Bank of Hungary and the Competition Authority, and that is available for everyone. And we agree in that competition is a very important, because if you have a monopoly, then you have the sufficient amount of income. You are not forced to innovate. If you are that is very interesting, because we experience that in a very competitive environment, you don't even have the sufficient amount of resources to make an innovation. That's why we think that between the innovation and competition, there is an U-shaped curve, a turned U-shaped curve. That means that you have to have some kind of oligopolistic power to make innovation, because it has a significant fixed cost. And that's why it is very interesting to investigate. So let me advertise our brand new database that is available online on the National Bank of Hungary, or available at the Competition Authority's website. So competition triggers competitiveness. Agreed totally with Magdalena in that case.
Thanks, András. Did you have any other final remarks apart from competition or forward-looking points? From the MNB's perspective, what are the most important issues facing the Hungarian economy?
Inflation is a primary enemy of the economy at the moment, and we believe, and according to our research, the very relative terms bad performance of the Hungarian economy was stemming from the high inflation, the higher than average regional inflation. And that's why we think that we have to concentrate on our primary mandate. We have to bring back the inflation to 3%, and that will give some boost for the economic activity as well. So we think that declining inflation and boosting the economy, those are pointing towards the same direction. We have to rebalance the economy. I think the private sector already accommodated to the new environment. That means that the saving of the households were increased, and also the investment ratio of the companies dropped or decreased, and that is reflected also in the current account balance. We welcome that actually the fiscal balance is going to improve over time. Hopefully that is going to improve a bit faster than previously expected. So we think that we are paying the price at the moment in the case of GDP growth to rebalance the economy, but we are on demand, and looking forward, we think that the supply side and the competitiveness are the two main factors behind the sustainable catching up process. So not the demand side policies. Those are not effective anymore. If you have an inflationary environment, you have to concentrate on competitiveness. You have to concentrate on the supply side of the economy and the potential GDP. That's I think our main message.
Thank you, Andras. Jakub, final remarks and forward-looking points for the outlook of the Polish economy.
Okay, so like Polish economy is similar like the EU, similarly like the region faced the difficult time. Inflation is still high, the growth was slower, but I think it's rather at transitory problems. Like in the longer perspective, we still expect convergence. We still expect catching up the Western Europe. There are plenty of opportunities regarding to the investments outlays in the energy sector that related to rise of new manufacturing. This should pay off. Like if we look at how the Poland expanded since the 2015 year, when we witnessed that the high tech manufacturing was one of the key driver of the economic success. This is not something. So this is something which is not fading. Like we still, despite we have a, let's say, weaker economic growth right now, the majority of international institutions, majority of forecasters still believe that the economy is capable to expand at the 3.5% per annum. This is probably the higher pace comparing to the Eurozone, comparing even to the majority of the region countries, maybe expect Hungary, but probably higher comparing to Slovakia or Czech Republic. So these prospects are still sound.
Thank you, Jakub, for outlining those forward-looking points for the Polish economy as well. And just before we conclude, Joka, if you have any concluding remarks and the outlook for continuing convergence in Central and Eastern Europe.
Sure. I'll keep it short and sweet, and mostly just want to echo Coleman's call for openness. But perhaps to broaden this a little bit, because I think when it comes to trade, when it comes to foreign investment, Hungary and other Central European economies are very well aware of the benefits. I think where these discussions about openness become much more difficult is indeed in the more heated topics. We've seen this in terms of food imports and restrictions on food exports, also why I highlighted the stabilizing role of food imports earlier. I think the other sensitive area we are all aware of refers to labor migration, but seeing as there has been so much discussion of the need for innovation and learning from each other, I think it is an area where that despite difficulties and sensitivities surrounding it, the opportunities are often underestimated.
Sorry, I'm on mute. Thank you very much, Joka, and thank you very much for all of our panelists. This has been a really enlightening discussion. I think we touched on a lot of issues. It sounds like there are some challenges that face the whole region, and also some particularities of different national economies in Central and Eastern Europe. And it sounds like in a increasingly difficult macroeconomic environment, some of the same dynamics such as trade, diversification, increasing FDI inflows, but high quality FDI inflows, regionalization, innovation are still the same issues which have been challenging the region for the last few decades. So as we look toward the future, it will be increasingly important to think about Hungary, Poland, and all of the CEE economies' role in the global economy, as well as some of the more domestic challenges that they face in their national economies. And there are a lot of challenges, but I hope that that means there are also going to be a lot of opportunities as well. So thank you very much. I think we'll end just 10 minutes earlier than planned, since we do not have any audience questions still, but thank you very much, everyone. And we look forward to hopefully seeing many audience participants at our in-person conference in Budapest on the 16th of November.
Thank you.
Thank you
Thank
very
you.
much. Thanks.
See you there.
Thank you very much.
Bye.
Thank you.